Stop using indicators right now, because they won't just slow you down. They'll cost you thousands of dollars trading. You see, after over 11 years of trading full-time and helping thousands of students through online trading campus, I've seen one thing ruin more traders than anything else: indicators. The very tools that are supposed to help you are often the reasons you'll start losing money. Today, I'm going to show you 3 things. Number 1, why using indicators can lose you thousands of dollars. Number 2, how professionals actually find high probability supply and demand zones. And number 3, a clever way to use indicators without losing money. But before we tear indicators apart, we need to be on the same page about why so many traders rely on them in the first place. Then we'll get into exactly why they fail, and finally, what to do instead. Why traders rely on indicators. Indicators feel safe. They simplify chaos into neat signals. Buy here, sell there. For beginners, that feels like a roadmap in a world that otherwise looks random. A chart loaded with indicators looks professional. It feels objective. It takes away the fear of making decisions on your own. In other words, indicators give the illusion of certainty in a business built on uncertainty. That comfort is tempting, but that comfort comes at a cost. Why indicators actually stop you making money? Here's the truth you need to hear. Reason number 1, they lag. Indicators summarize past price, so they're always behind. By the time MACD crosses, the move is already underway. By the time RSI flashes overbought, smart money is already preparing to step in on the other side. You are reacting, not anticipating. Reason number 2, they contradict. One signal says buy, another says sell. Another says wait. It's chaos. The more you load up, the more confusing it gets. Charts turn into Christmas trees, colorful, flashing, impressive looking, and useless when it's time to make a decision. All of those tools are derived from price. So price must move first before the indicator reacts. You're always late to a party. Institutions already started. Reason number 3, they paralyze you. More tools, less confidence. You wait for confirmation that never comes, or you jump on a flashing signal with no grasp of the bigger picture. Many retail traders even believe the market moves because an indicator flashed a signal. It doesn't. Markets move because of fundamentals, and institutions execute through supply and demand, not because an indicator told them to click buy or sell. And here's the most dangerous part. Indicators sometimes work, sometimes convinces you there's a code to crack. You double down after a few lucky winners, then it fails and you don't know why. You end up chasing signals instead of building a repeatable process. Consistency never shows up. The secret? A 2-step mechanical process. Fundamentals and timing. Professionals strip away noise and follow a clear mechanical process that mirrors how institutions operate. Step number 1. Build your market bias using fundamentally derived indicators, not price-derived tools. I'm talking about what drives price. CUT report to see where smart money is positioned and what retail, the dumb money, is doing. Seasonal tendencies, valuation models to spot fair value. Together, these form a professional toolkit for directional bias. If you want a deep dive, comment below. I might start a series on reading the CUT report. Step number 2, time the market using supply and demand. Institutions don't buy because RSI hit 30 or sell because MACD crossed. They transact where they can move sides, at zones of imbalance. Not all zones are equal. Some are weak and retail driven. Others are strong, untouched and explosive. Your edge is filtering the weak out and focusing only on institutional footprints. Bring both steps together and you have a complete trading ecosystem. Fundamentals for bias, supply and demand for timing. The CIF Framework covered Imbalance, Freshness. Use this professional filter to separate the weak from the strong zones. C stands for covered, multi-time frame, big brother, small brother. The best setups occur when a higher time frame big brother zone covers a lower time frame smaller brother zone. Enter on the smaller brother for a tighter zone and a better risk to reward proposition. But stay aligned with the big brother for institutional strength. The big brother wins. If you want the full breakdown, watch my video, the #1 supply and demand trading rule that makes you a pro instantly, full course. I stands for imbalance. Strong zones show a clean base and a decisive leg out that leaves a sharp imbalance. Big candles, strong departure, minimal overlap. That's the institutional footprint. Weak zones drift, stair step and wick. That's retail. F stands for freshness. Strong zones are fresh and untouched, with orders likely resting. Once institutions fill, they rarely defend the same zone multiple times. Each retest erodes the footprint and the edge. Weak versus strong zones. Price action walkthrough. Most beginners mark 5, 6, even 10 levels. Every pause gets a line. Apply covered, imbalance, freshness, and most of those vanish. Week 1. Messy base, overlapping candles, shallow departure, retail footprint. Week 2. Looks clean, but it's already been tested multiple times. Freshness is gone. Strong, clean base, explosive leg out, sharp imbalance, untouched, institutional footprints intact. This is where smart money loaded. This is where we build trades. Focus only on strong zones and your chart goes from chaos to clarity. Practical application. Building a trade. The trading ecosystem. Here's how to turn this into a plan. Step #1. Top-down analysis. Start with higher time frames, where institutions leave the biggest footprints. If your zone isn't aligned with your higher time frame, you're trading against the tide. Step #2, zone selection. Apply covered, imbalance, freshness. Mark only strong zones. Step #3, risk to reward plan. Trading is a math problem. If the payoff isn't asymmetric, skip it. Risk $1 to make $1.20? The math doesn't work. Risk $1 to make $2 or $3? Now you can be wrong more often and still grow. We never settle for less than 1 to 2 and ideally 1 to 3 or better. Step #4, execution. Once the zone and your risk to reward are confirmed, drop to your entry time frame. Place the order inside the zone using the preferred or the wider version of that lower time frame zone. Stop goes beyond the base. Target the next opposing imbalance. Step #5, set and forget. When the plan is set, walk away. Do not babysit every candle. The more you interfere, the more emotions take over. Let the math do its work. Mindset shift. What the 1% know. Trading isn't about being right. It's about being profitable. Most traders chase certainty with indicators, signals, and confirmations. Professionals structure trades so winners are bigger than losers. If you sell for $1 and make $2 back, you don't care if half of your trades fail. You can lose half and still be profitable long term at 1 to 3. This is what separates the 99% from the 1%. How to actually use indicators the right way. Don't professionals use indicators? Yet, but not as signals. Professionals decide using fundamentals for bias and supply and demand for timing. Indicators can support that decision, not replace it. Moving averages. Useful to visualize slope after you confirm direction via higher time frame structure and supply and demand. They smooth the picture, they do not define the trade. Volume or order flow tools. Helpful to highlight liquidity pockets around your zones. They add context on where participation may increase. But the zone comes first. Without the zone, volume is just noise. Golden rule. Indicators should never decide the trade. Fundamentals build your bias. Supply and demand zones define timing. Institutional footprints confirm execution. Indicators can only support what is already clear. Flip this mindset and you stop trading like retail. You start thinking like institutions. Indicators look like shortcuts, but they lag, they contradict, and they create dependency. They blind you to what drives the market. Markets move because of fundamentals, interest rates, monetary policy, institutional positioning. Fundamentals set the bias. Technicals time the entries. We use supply and demand zones to read institutional footprints and pick our spots. Not all zones are equal. Your edge is covered, imbalance, freshness. Combine strong zones with proper risk to reward proposition, then let the probabilities play out. Keep indicators only a supportive context, never as a decision maker. Do less, but better. Trade less, filter harder. Demand asymmetric risk to reward. Align with institutions, not retail noise. Do that consistently and you stop making the mistakes that hold back 99% of traders. If you want to take this further, watch my full supply and demand strategy breakdown on my channel. It's part of the complete OTC trading ecosystem and it will change the way you approach the markets forever.